A few episodes ago that ran for 5 years without knowing whether it made money or lose it. I want to come back to it because today I can tell you exactly why it was blind. It was not that the owner was careless. There was an accountant. Money was being recorded, but the accountant only recorded one thing: revenue. Money came in, it got written down. That was the entire financial system. There was no chart of account, none. And without one, 5 years of numbers told the owner exactly one fact: how much money arrived, not where it went, not which part of the hotel earned it, not which part was bleeding, just money came in. That's not accounting, that's a cash diary. And today I'm going to show you the thing that hotel never had: the chart of accounts. And why setting it up by department is the difference between reading your hotel or just watch cash move through it. What chart of account actually is? Let me keep this simple because the word sounds more intimidating than the idea. A chart of account is just the list of label boxes you sort every shilling into, every bit of money that comes in and every bit that goes out. Revenue boxes, cost boxes, that's it. The whole game is in how you design those boxes. Get the boxes right, and at the end of the month, the number fall into place and tell you a story. This department earned this, cost that, keep the difference. Get the boxes wrong, too few, too generic, and the same numbers tell you nothing because everything important got dumped into a box labeled expenses and lost. So the chart of account is not an accounting formality. It's the structure that decides which question your number can answer. Design it badly and there are questions your hotel can never answer, no matter how good your accountant is. Treating the hotel as one big unit. Here's the mistake I see most often in small hotels, and it's almost always the same one. They treat the hotel as one single unit. All revenue flows into one pile, all costs flow into another. At the end of the month, you just subtract one from the other and you get a single number. Profit or lose for your hotel. It sounds reasonable, right? It's catastrophic because a hotel is not one business. It's several businesses sharing a building. Rooms is one business. Food and beverage is completely different business with different costs, different margins, and different economics. The spa, the third. When you blend them into one pile, you lose the ability to see any of them. Most small hotels chart of account don't allocate revenue and cost by department, and the moment you skip that, you have blended yourself to the most important question in the building: which part of my hotel makes money and which part loses it? A generic chart of account, the kind you are using for a trading company or a shop, treats the hotel like it sells one thing it does not. And that mismatch is where the trouble starts. Rooms funding the kitchen. Let me tell you exactly what the blindest costs, because it's not abstract, it's very specific, and I have watched it happen. When the hotel is one bucket, the owner cannot determine cost of goods sold. They cannot see what the food and beverage actually cost to produce versus what it brought in. So here's what happens silently month after month. Rooms makes good money, strong margin. Rooms usually does. Food and beverage, meanwhile, is losing money, overportioned, overstuffed, poorly costed, and leaking. But because it's all one bucket, the strong profit from rooms cover the loss from the kitchen. The combined number still looks positive, so the owner relaxes. We are profitable. Rooms is quietly funding the defect in food and beverage, and because again it's one bucket, nobody can see it happening. That hotel does not have a profit. It has a profitable department carrying a loss-making one on its back, and an owner who has no idea because the chart of account was never built to show him. Build the account by department, and on day one you see it. Rooms plus this much, F&B minus that much. Now you have a decision to make. Fix the kitchen or close it. Without departmental accounts, you don't even know there's a decision to be made. You just slowly bleed profitably for 5 years. The 4 departments simplify USALI. So how do you build it right? You don't have to invent this. There's a global standards for hotel accounting. It's called USALI, the Uniform System of Account for the Lodging Industry. The big chain all used it. It's the professional language of hotel finance worldwide. But the full standard is heavy, built for large hotels with dozens of departments. For 20 to 80 room property, you don't need all of it. You need its logic. Simplified, that's more professional than ignoring the standard and more practical than drawing it. Here's the 4 departments that matter. 100 rooms. Your profit engine, room revenue on one side, on the other, only the cost that truly belongs to rooms. Housekeeping by rule, guest supplies, linen, OTA commissions, keep it clean, and you see your true rooms margin. 200 food and beverage, the department that hides loses. Here's the non-negotiable rule. Separate food costs from beverage costs. They behave completely differently. Beverage should run far leaner than food. Blend them and a bar bleeding money can hide behind a kitchen doing fine. Or the reverse. 300 other operated. Spa, laundry as a service, parking, anything minor that earns, each tracked on its own. You want to know. If it doesn't, you really want to know. 400 undistributed. The costs that serve the whole hotel and cannot fairly be bent on one department. Administration, marketing, maintenance, utilities. These sit apart and they come out after you've seen each department on profit. That order matters, and it's the next thing I will show you. The profit waterfall. Once the books are built by department, your hotel's profit read as a waterfall, top to bottom, each level revealing something the level above couldn't. Start with each department revenue, subtract the department direct cost, and you get departmental profit. This is the number small hotel never see, and it's most important one in the building. It tells you cleanly which department earns and which drain. Add up all the departmental profit, then subtract the undistributed expense, admin, marketing, maintenance, utilities, and you reach GOP, gross operating profit. This is the number that tells you how well the hotel is being operated before the cost that operator doesn't control. Finally, subtract the fixed charges, rent, insurance, depreciation, financing, and you reach net profit, the owner's number. Here's why the orders matters. GOP measures the operator. Net profit measures the investment. A generic chart of account collapses these into one figure, and you lose both lenses. The departmental waterfall gives you every level, so when something's wrong, you know exactly which floor of the building to walk to. How to build yours. 4 steps to a working chart of accounts. Start from your operating model. The departments you defined in episode 3 are your account structure. Full FMB means a full 200 series. Breakfast only means a lane 1. The charts mirror the model. Build it before the account system goes live. Week 7 on the timeline. Loading it after you have started trading mean retagging months of transactions by hand. 3. Separate every COGS from every payroll, from every operating cost, especially food costs from beverage costs. The separation are where the insights lives. 4. Test it with one question. Can it show me each department profit on its own? If yes, it works. If no, it's a cash diary with extra steps. What's coming? The reframe. A chart of account is not a paperwork for your accountant. It's the lens you see your hotel through. A Blu-ray lens and a sharp lens point at the same building, but only one lets you act before the damage is done. Next episode, procurement. Once you can see cost by department, the next question is how many gets spent in the first place. Purchase order, approvals, and the control triangle that that stop cash walking out from the back door. The ask. One thing before you go. If your hotel is already operating, ask your accountant one question. Show me last month's profit for the rooms department and separately for food and beverage. If they can do it in 5 minutes, your chart of accounts works. If they cannot, that's not their failure, it's the structure. And now you know how to fix it. Subscribe so you don't miss episode 7.